Ladies and gentlemen, investors and market enthusiasts, today I want to talk about something profound that has just happened in the silver market and why it matters to every investor around the world. China, as you know, controls a significant portion of the global silver supply. Their recent emergency actions, halting certain trading and tightening export regulations, have caused a ripple that is being felt across the entire market. Now, let's be very clear. Markets are not just numbers on a screen. They are reflections of real-world supply and demand, human behavior, and policy interventions. What China has done is a strategic move. By restricting exports and tightening domestic supply, they have effectively shifted the balance of the global silver market overnight. China's recent actions in the silver market represent one of the most significant shifts in commodities in recent history. To understand why this is so impactful, we need to consider the unique role China plays in the global silver supply chain. China is not just a large consumer of silver, it is also the world's leading producer, refiner, and exporter of the metal. Roughly 60 to 70% of refined silver that moves through global markets passes through Chinese hands at some point. When a country with that level of influence decides to take emergency actions, the effects ripple across the entire market almost instantly. The emergency measures implemented by China included halting trading in key silver investment products, imposing tighter controls on exports, and introducing licensing requirements for companies that want to sell silver abroad. These measures were largely unexpected and have created both physical and psychological shocks in the market. From a physical perspective, the restriction on exports directly reduces the amount of silver available outside China. Many industrial and investment sectors rely on this steady flow to maintain their operations. For example, manufacturers in electronics, solar energy, and automotive sectors depend on predictable silver supplies. When China restricts exports, these industries suddenly face potential shortages or the need to pay higher premiums for the limited metal available in international markets. Investors, traders, and industrial users all start reacting to the reality that the supply-demand balance has shifted overnight. This is why prices can spike rapidly when such announcements are made. The psychological effect is equally powerful. Markets are not just driven by supply and demand, they are also driven by expectations and sentiment. When investors see a major player like China intervening decisively, it triggers both fear and speculation. Traders may rush to buy physical silver or paper contracts anticipating a shortage, amplifying price volatility. This creates a feedback loop. The market reacts to policy, which changes prices, which in turn influences further trading behavior. Moreover, this event highlights a structural vulnerability in global commodities markets, heavy dependence on a single country for supply. When one country controls the majority of a critical resource, any sudden policy shift has outsized consequences. This is why China's move is not merely a temporary blip or short-term event. It is a structural factor that will influence silver markets for years to come. Investors must understand that events like this are part of the broader landscape of global investing, where policy, geopolitical considerations, and industrial strategy intersect with market mechanics. Finally, this situation underscores the importance of distinguishing between paper and physical markets. Futures contracts, ETFs, and other paper representations of silver are affected by sentiment and liquidity in ways that can exaggerate the real impact of supply changes. Physical silver, on the other hand, responds to the actual availability of the metal. The gap between these two can widen dramatically when a supply shock occurs, as we are seeing with China's intervention. For investors, understanding both dimensions is essential for managing risk and identifying opportunities. In conclusion, China's emergency actions in the silver market are a stark reminder that global commodities are influenced not only by traditional market forces, but also by policy decisions and strategic considerations of major players. This single country's move has reshaped supply chains, triggered price volatility, and sent a signal to investors worldwide. Understanding the role of China in silver is no longer optional. It is essential for anyone serious about investing in this market. The immediate impact is clear, but the lessons extend far beyond this one event, highlighting the interconnectedness of global markets and the power of policy to move prices in ways that pure supply and demand analysis alone cannot explain. Markets are often misunderstood as mere collections of numbers, graphs, and trends, but in reality, they are a reflection of the underlying forces that govern human behavior, supply and demand, and policy actions. When we say markets reflect reality, what we mean is that every price, every movement, and every fluctuation is ultimately tied to something real. Whether it's tangible resources like silver, oil, or wheat, or intangible factors such as expectations, confidence, or policy interventions. It's essential for investors to recognize that markets are not random. They are driven by cause and effect, relationships that are influenced by both natural economic forces and human decisions. In the case of the silver market, China's emergency actions illustrate this principle perfectly. The market didn't react merely because traders were guessing or speculating for no reason. It reacted because the real-world supply of silver, both domestically in China and internationally, changed overnight. When a country that controls a major share of global production restricts exports, it alters the fundamental balance between supply and demand. Industrial users need silver for manufacturing electronics, solar panels, and other critical technologies. Investors seeking a safe haven or speculative gains also respond to the new scarcity. Prices move because the reality of availability has changed, and the market reflects this change almost instantaneously. But markets also reflect human behavior. When investors perceive risk or opportunity, their collective actions amplify the underlying forces. In other words, markets don't just passively record reality, they interpret it through the lens of sentiment and decision-making. Fear, greed, and uncertainty are powerful drivers of price movements. For instance, when news of China's intervention reached international markets, traders anticipated shortages and potential price spikes. This anticipation, combined with real supply constraints, created a feedback loop where expectations themselves became a force that drove prices higher. This is why market movements often appear exaggerated in the short term. The reality they reflect is not only the actual supply and demand, but also the psychology of millions of participants acting simultaneously. Understanding that markets reflect reality also requires distinguishing between short-term noise and long-term fundamentals. Short-term price swings can be volatile and influenced by speculation, news cycles, and liquidity issues. But over the long run, markets tend to align with real economic conditions. In the silver market, while prices can spike or dip wildly in response to trading activity, the underlying value is tied to the availability of physical silver, industrial demand, and strategic considerations like geopolitical interventions. Investors who recognize this alignment between market prices and real-world fundamentals are better positioned to make rational decisions rather than reacting emotionally to temporary volatility. Another important aspect is that markets reflect not just economic reality, but also policy and structural forces. Governments, central banks, and regulatory bodies play a significant role in shaping markets. China's move to restrict silver exports is a policy-driven change, and markets immediately reflected the impact. This shows that investors cannot focus solely on supply and demand in isolation. They must consider the broader context of policy, regulation, and geopolitical strategy. Markets will always incorporate these factors because they influence both actual outcomes and expectations about the future. Finally, understanding that markets reflect reality encourages disciplined decision-making. It reminds investors that prices are signals, not random events. Each movement communicates information about scarcity, opportunity, risk, and the actions of major players. By interpreting these signals thoughtfully, rather than reacting impulsively, investors can navigate complexity and uncertainty with a strategic mindset. Markets are not perfect predictors of the future, but they are mirrors of the present, and understanding what they mirror is essential for making intelligent investment choices. One of the most important distinctions every investor must understand is the difference between paper silver and physical silver. This may sound straightforward, but it is fundamental to navigating the silver market, especially during periods of volatility like the one we are experiencing now with China's recent interventions. Paper silver refers to financial instruments that represent silver, such as futures contracts, exchange-traded funds, ETFs, and other derivatives. Physical silver, on the other hand, is the actual metal, bullion, coins, or bars that exist in warehouses or in your possession. While these two forms are interconnected, they behave differently under stress. And misunderstanding this can lead to significant miscalculations in risk and opportunity. Paper silver exists primarily for convenience, liquidity, and speculation. Futures contracts, for example, allow traders to bet on price movements without having to take delivery of physical metal. ETFs offer exposure to silver's price without the need to store or secure it personally. These instruments provide flexibility and leverage, making them attractive to institutional investors, hedge funds, and retail traders alike. However, their value depends largely on trust, liquidity, and the assumption that the paper claims can be redeemed for physical silver if necessary. When markets are functioning normally, paper and physical silver prices are closely aligned. The market assumes that if you want to convert your paper silver into physical silver, the system will allow it. Physical silver, however, operates under a different dynamic. Its value is tied directly to availability, demand, and the costs of extraction, refinement, and storage. Industrial users require physical silver to manufacture electronics, solar panels, medical equipment, and other technologies. Investors who hold bullion do so because they recognize its intrinsic scarcity and its historical role as a store of wealth. Unlike paper instruments, physical silver cannot be created instantaneously or synthetically to meet market demand. It is finite, tangible, and subject to the laws of supply and demand in the real world. The critical lesson here is that during periods of stress, paper and physical silver can diverge significantly. If a country like China restricts exports or if physical inventories are constrained, paper silver may continue to trade based on liquidity, speculation, or delayed arbitrage, while the real-world supply of physical silver tightens. This divergence can create sudden price spikes in physical silver, premium increases for bullion, and frustration for investors trying to convert paper claims into actual metal. Understanding this distinction is essential for risk management. Those who treat paper silver as equivalent to physical silver during crises may find themselves exposed to unforeseen shortages or costs. Another important aspect is that paper silver is often leveraged. Traders can control large quantities of silver with a fraction of the actual capital required for physical ownership. This leverage amplifies volatility and can create dramatic short-term swings in price. Physical silver does not have the same leverage risk. It moves in response to supply and demand, industrial use, and investor sentiment rather than speculative positions. Investors who focus solely on paper markets without appreciating the physical realities may be caught off guard, and supply constraints trigger rapid repricing. Finally, the distinction between paper and physical silver is a lesson in principles. Markets reflect reality, but the form in which reality is represented matters. Paper silver provides convenience and liquidity, but physical silver embodies scarcity and intrinsic value. Wise investors recognize this duality, balancing exposure between the two and preparing for scenarios where paper claims may not fully capture the scarcity of the real metal. In times like these, when a major player like China intervenes, understanding the difference between paper and physical silver is not optional, it is essential. Those who internalize this principle are better positioned to navigate risk, seize opportunity, and protect wealth in a world where market volatility and policy interventions are increasingly interconnected. If you want, I can expand key point 4, geopolitical and policy risks, in 600 words next, keeping it in the same Ray Dalio-style narrative so your speech becomes a full, polished script. Investing is never just about numbers, charts, or historical trends. It is also about understanding the forces that shape those numbers. Among the most powerful forces in markets today are geopolitical developments and policy decisions. These forces can move markets in ways that supply and demand alone cannot explain, and they are especially evident in the recent events surrounding the silver market. China's sudden restrictions on silver exports serve as a perfect example of how geopolitical and policy risks can dramatically alter the investment landscape. Geopolitical risks are the consequences of actions, decisions, and tensions among nations. They encompass everything from trade policies and sanctions to military actions and strategic resource management. When a country that controls a significant portion of a global commodity decides to change its policies, the repercussions are immediate and global. In the case of China, which dominates silver refining and production, their emergency actions created a sudden scarcity of supply for international markets. Investors who were focused solely on traditional market fundamentals without considering the geopolitical context were caught off guard by the magnitude of the price movements. Policy risk, on the other hand, involves government interventions in markets, including regulations, licensing requirements, and emergency measures. Such actions are intended to achieve strategic, economic, or political objectives, but they also have the power to create substantial market volatility. China's imposition of export licenses for silver and halts on certain trading instruments exemplifies this type of policy risk. While these measures may serve domestic goals, such as stabilizing internal markets or preserving strategic resources, they simultaneously impact global investors and industries dependent on silver. The lesson for investors is clear. Policy actions can reshape supply, pricing, and market dynamics overnight. One critical aspect of geopolitical and policy risk is that it is often unpredictable and asymmetric. Unlike cyclical economic trends or seasonal supply-demand patterns, these risks can emerge suddenly and without precedent. Markets may attempt to price in risk, but the timing, scale, and consequences of geopolitical or policy interventions are rarely fully known in advance. For example, while analysts might anticipate some form of regulatory tightening, the sudden sweeping measures implemented by China exceeded expectations and caused extraordinary volatility. This unpredictability is precisely why disciplined investors study not only the fundamentals of supply and demand, but also the strategic intentions and potential moves of major global actors. Moreover, geopolitical and policy risks do not exist in isolation. They interact with other market forces. When supply is constrained due to policy intervention, investor sentiment and market psychology amplify the effect. Traders rush to secure positions, hedge funds leverage paper instruments, and speculative behaviors magnify price swings. In this way, the combination of policy risk and human behavior can transform a structural supply issue into a global market shock. Understanding this interaction is essential for navigating complex markets. Another important lesson is that geopolitical and policy risks are increasingly tied to strategic resource management. Countries like China are treating commodities, such as silver, not merely as trade goods, but as strategic assets critical to technology, energy, and national security. For investors, this means that markets are influenced not just by economics, but by broader national priorities. Ignoring these factors can lead to mispricing, unexpected volatility, and missed opportunities. Ultimately, understanding geopolitical policy risks is about preparation scenario thinking. Wise investors do not attempt to predict every event. Rather, they consider multiple possibilities, assess potential impacts, and build resilience into their portfolios. They recognize that events like China's silver intervention are part of a larger pattern. Markets are increasingly shaped by the interplay of global policy, national strategy, and investor behavior. By appreciating the power of these forces, investors can make more informed decisions, manage risk effectively, and position themselves to seize opportunities even in turbulent environments. If you want, I can now expand key point 5, opportunities in market stress, in 600 words, keeping the same Ray Dalio-style tone so your full speech continues seamlessly. Markets are rarely linear, predictable, or calm. In fact, periods of stress, volatility, and uncertainty often reveal the true nature of markets and, more importantly, the true opportunities for investors. Understanding how to navigate market stress is a fundamental principle of sound investing, and nowhere is this more evident than in the recent disruptions in the silver market caused by China's emergency actions. These moments of stress, while unsettling for many, are precisely where disciplined investors can differentiate themselves from the crowd. Market stress occurs when fundamental conditions are disrupted, whether by sudden policy decisions, geopolitical events, or rapid shifts in supply and demand. In the silver market, China's intervention created an immediate scarcity of physical silver and a ripple of uncertainty across paper markets. Prices spiked, volatility surged, and short-term trading behavior became exaggerated. For many investors, this scenario can be intimidating. Fear is a natural reaction to uncertainty, and it can drive impulsive decisions that often lead to losses. However, for those who understand the principles of market cycles, volatility is not merely a risk, it is also an opportunity. Opportunities in stress markets arise because markets are, in essence, aggregations of human decisions. During periods of panic or uncertainty, irrational behavior often dominates. Traders may overreact to news, overleverage positions, or make decisions based on emotion rather than fundamentals. This behavior creates mispricings, situations where the price of an asset diverges significantly from its intrinsic value. In the case of silver, the sudden scarcity triggered by China's export restrictions has temporarily disconnected paper prices from physical market realities. Investors who understand these dynamics can position themselves to capture gains as markets gradually reconcile with reality. Another critical aspect of opportunities in market stress is the role of preparation and discipline. Those who succeed in volatile conditions are not merely reacting to events. They have anticipated potential scenarios and have strategies in place. This requires studying fundamentals, assessing risk, and considering multiple possibilities. In silver, a prepared investor understands both the industrial demand for physical metal and the implications of policy decisions. They recognize that while prices may swing wildly in the short term, the long-term drivers, scarcity, industrial usage, and strategic policy, will ultimately determine value. This foresight allows them to act decisively when opportunities present themselves. Market stress also offers opportunities for learning and gaining insight. By observing how markets react to crises, investors can bet to understand the interplay of psychology, policy, and supply-demand dynamics. These lessons are not merely academic, they translate directly into improved decision-making for future investments. Understanding that fear often drives mispricing, that leverage can amplify volatility, and that fundamentals ultimately reassert themselves equips investors with the tools to navigate not just silver markets, but all complex markets. Importantly, seizing opportunities in market stress is not about reckless speculation. It is about calculated risk-taking. Investors must weigh potential rewards against risks, diversify appropriately, and maintain discipline even when markets appear chaotic. By doing so, they can turn volatility into a strategic advantage rather than a source of panic. This is the principle that underpins long-term success, recognizing that market disruptions are not just problems to survive, but opportunities to thrive if approached with knowledge, patience, and discipline. Finally, market stress often separates short-term speculators from long-term investors. Those who focus on fundamentals, understand the underlying principles, and maintain a rational approach are the ones who capitalize on periods of uncertainty. China's actions in the silver market have created immediate disruption, but for investors who understand these lessons, the stress reveals hidden opportunities, clarifies risk-reward dynamics, and reinforces the value of disciplined, principle-based investing. By embracing these opportunities thoughtfully, investors can not only protect wealth, but also position themselves for significant gains in a market that rewards those who prepare, analyze, and assess strategically. If you want, I can now expand key point 6, principles over speculation, in 600 words, completing the full Ray Dalio-style speech so it becomes a polished, comprehensive script for narration or presentation. One of the most important lessons in investing, and in life more broadly, is the distinction between principles and speculation. Markets are often filled with noise, short-term movements, rumors, and emotional reactions. But successful investors focus on timeless principles rather than attempting to predict every twist and turn. This distinction is especially critical in times of heightened volatility, such as the recent disruptions in the silver market triggered by China's emergency actions. While speculation may offer the allure of quick gains, principles provide the foundation for sustainable success. Principles are enduring truths about how markets work. They are not guesses about what will happen tomorrow or next week. They are observations about cause and effect relationships that consistently influence outcomes over time. For example, one principle is that scarcity drives value. Physical silver is finite, and when a major producer restricts supply, the value of the metal tends to rise. Another principle is that human behavior is predictable and aggregate. Fear, greed, overreaction, and underreaction all create patterns that can be observed, studied, and anticipated. By focusing on these underlying truths, investors are better equipped to navigate uncertainty without being swayed by short-term noise. Speculation, on the other hand, often relies on attempting to predict the unpredictable. Traders may place bets based on rumors, temporary trends, or emotional reactions to headlines. While speculation can be profitable in the short term, it carries substantial risk, particularly during market stress. The silver market illustrates this clearly. When China intervened, silver prices experienced dramatic swings, often disconnected from the realities of physical supply. Speculators who reacted impulsively to these swings without understanding the fundamentals risked significant losses. In contrast, investors who adhered to principles, understanding supply constraints, industrial demand, and the role of policy, were positioned to make rational decisions and identify opportunities. Principle-based investing is also about preparation and scenario planning. Rather than reacting to every headline, disciplined investors develop frameworks for evaluating risk and opportunity. They consider multiple outcomes, assess probabilities, and plan for contingencies. For instance, in the silver market, a principle-based investor recognizes that China's actions could affect both physical availability and market psychology. By preparing for these scenarios in advance, they can act strategically when volatility occurs rather than being caught off guard. This approach reduces emotional decision-making and increases the likelihood of achieving long-term objectives. Another critical element is risk management. Principles guide investors in understanding not just potential gains, but also potential losses. They encourage diversification, position sizing, and the use of protective strategies to mitigate the impact of unforeseen events. Speculation often ignores these fundamentals, focusing narrowly on upside potential without fully appreciating downside risk. By contrast, principle-based investing balances opportunity with caution, ensuring that portfolios can withstand shocks while capturing upside when conditions are favorable. Finally, principles create a framework for learning and improvement. Markets are dynamic, and no single event provides all the answers. However, by adhering to principles, investors can systematically analyze outcomes, refine strategies, and continuously improve their understanding. For example, observing how silver markets respond to China's policy interventions reinforces lessons about scarcity, geopolitics, and investor psychology. Over time, these lessons compound, giving disciplined investors a durable advantage over those who rely solely on short-term speculation. In conclusion, focusing on principles over speculation is not just a theoretical preference. It is a practical necessity for navigating complex markets. Speculation may yield short-term excitement, but principles provide consistency, resilience, and a roadmap for long-term success. In the context of the silver market, where policy, scarcity, and human behavior intersect, adhering to principles allows investors to make rational decisions, identify opportunities amid volatility, and manage risk effectively. By prioritizing principles, investors equip themselves to succeed not only in silver, but in all markets where uncertainty, complexity, and change are constants.